Over the last week, we've seen markets around the world recover, hitting key resistance zones that we were talking about for the S&P 500, NASDAQ, and of course being led by the stocks that we like at the moment, NVDA and semiconductors. But what has changed over the last week, and why should we be paying attention a little bit more to the equal weight, and more importantly, maybe even the Russell 2000? Well, over the last 24 hours, we've seen a dangerous looking candle for the rest of the market appear. But when we look underneath the hood at this earnings season so far, it might seem a little bit more like an opportunity. Let's discuss stocks, commodities, and cryptos together, guys. There's a lot to go through, including what's going on in the options world this week. It's a massive expiration into that inflation number. Well, welcome back everyone to The Daily Show. My name's Tom, and in today's video, I thought we'd start off with some data around what's going to happen probably over the next 3, 6, and 12 months, and then we'll talk about why this earnings season is doing okay so far. More importantly, where are the next opportunities for us, as we've already seen NVIDIA recover over 30% from its lows last week. Well, first up, let's talk VIX, because of course, the Volatility Index has been giving a lot of triggers. Now, when we see a VIX over 38, which we don't often see, but when we have seen it, we've gone back through over 3 decades here with Sentiment Trader, you'll notice that 96% of the time over the next 12 months, markets are bullish. Now, the reason why that is because the VIX over 36, or 38 in this case, is very, very high. In fact, it's quite rare to get that. It usually comes with what we call capitulation of the markets, a complete and utter freak out. Now, last week we saw what we could call a flash crash, and it's important to note that this flash crash occurred when we're only seeing around 33% of day trade movement over 1%. Now, that's not a very volatile year, and you'll notice that in all of these points here, when we tend to have a calendar year coming in with not that much daily volatility, it usually is kind of like very good for, I guess you would say, the bulls. So, of course, we need to look at whether the earnings make sense to that. Another argument has been made, and I've been reading a couple of your comments down below about how bad things are. And I just thought I'd clarify this. Look, I think we all agree that there are several problems in the economy. There's no doubt that you do want to probably start to think about late cycle concepts. I know a lot of you don't like that idea, but late cycle doesn't mean you have to remain uninvested in markets and be totally freaked out. Late cycle just means that you need to look at different sectors. You need to look at more defensiveness to a degree. And of course, you're not going to be looking at taking maximum leverage when it comes to your investments, because that can go very bad. We'll give you an indicator later on today's video that can help you to try to determine whether we are in late cycle. And remember, this is irrelevant to what the news has to say about things. We don't care what the news has to say. We don't care what the general media has to say. What is the market actually telling us is one of the key points. Now, because you might think that we're starting to get into late cycle as well, or we're already in a recession, some people may think, then we have to be starting to consider what are the most correlated markets to right now. What does the market look like in terms of structure? Something we try to do here on the channel. And we're looking at 1998 and 2018, both periods where we started to get rate cuts from the Federal Reserve. And then, of course, what did they do? They claimed that they had solved the problems of the markets. And then a few weeks later, we actually ended up crashing. So we do need to be remembered that the biggest thing here is, of course, the uninversion of the yield curve. We kind of saw that a week ago, and we'll keep tracking it on this channel, along with trying to update when we start to see problems. We've already debunked some things like the SARM rule. We did that about a week ago, which helped us to, of course, remain bullish in this current very nice upward tick. Let's talk about forward PE ratios. Now, the 30-year average is 16.73. This is courtesy of Mike Zaccardi over on X. And you can see that we are over 1 standard deviation. Do remember, though, 30 years not the best way to look at it. We've pretty much been trading around 18 for the QE period and the buyback period in markets. And we are in a buyback period up until, I think, mid-September-ish, which basically means that, yes, the big funds are going to be purchasing, or the companies in this case will be purchasing $4 to $5 billion a day, and that makes it a net buyer's market. So you've got to remember that this is a bit corrupt when it comes to buybacks. It's one of the biggest reasons that markets have been up over the last 10 years, and we are in that period of time right now. So the window is open, as we reported in our previous video. Go check out that data if you're interested. EPS guides, we posted this over on X. It looks like sentiment is starting to improve. We're getting guidance momentum improving across the board. That's not exactly what we should be seeing into a bear market. Usually things are starting to slow there. And positive surprise was pretty good across the board. You can see here that the overall revenue and earnings were pretty much on there. Absolute positive, 73%. I'd say that was pretty good in general. And the earnings season, I would say, is pretty much coming in as we would expect. There's another way of looking at this, which is EPS consensus. And we note that, of course, the market is going to be putting a huge burden on the smaller caps moving forward. Take a look at Q3, Q4, Q1 2025, and then specifically Q2 2025, which is expected to be a blockbuster for small caps in particular. Now, we do know that there's been some revisions down now, which is typical of Wall Street. They always like to do a little bit of revision, then knock up the ones that are super late on. And this is a bit of an excerpt I thought I'd read here from Liz Young. Thomas says, while Q2 earnings results were stronger than expected, consensus now expects S&P 500 EPS growth of around 5.4% year on year in Q3, down from the July 10th estimate of 7.6%. So down a little bit, but again, this is pretty normal. They always do this. The following few quarters also saw some revisions lower, and this was true for large and small cap companies. But in general, they are still pretty close to where they were. And of course, they're still very much stacked towards the Russell 2000. You'll notice they've actually put up the later ones here. So you remember the market trades in the future. So if you see any kind of recovery, anything like that, that can really bring in things such as this chart here. Now, this is SPW, so basically the equal weight RSP for many people versus the S&P. And we know that it's historically low. Not the lowest it's ever been during this concentrated market, which is an interesting point. But the Russell 2000 is starting to play in where it's been kind of like pretty good to be starting to look at the Russell 2000. We have a great read on that from a technical level coming up later on today's show. Let's talk CPI now. We all talked about the inflation numbers. The most notable thing here, I think, was food and shelter. In particular, shelter continues to be a bit of a problem. It's going to be very hard to see on this chart right now, but basically shelter was 0.17% during June, and it went back to being 0.38. And I'll just read out some numbers for shelter. 0.4, 0.38, 0.42, 0.43, 0.63, 0.4, 0.45. So this is basically what I always consider the sticky part of inflation, along with food, which also has been relatively sticky, and really where some of the big drops were, of course, in used cars. So used cars dropped another 2.3%, and yeah, it's not a great time to own lots of cars because you are losing a lot of money, particularly if you're in electric cars right now, well, at least Australia, that's the way it is. Core CPI inflation has been tracking down. A lot of people, of course, lauding this as being the greatest thing ever, and basically it opens up rate cuts. So it opens up the Federal Reserve to now do some rate cuts, although shelter kind of shows you that that sticky inflation could still be there. And that can also open the dreaded reflation that we made a mistake in during the 1970s. So, of course, will we get that again? I'd be interested to know your comments down below. Are we going to see re-inflation, the deadly one that we don't want if you are a market bull? No recession versus recession into rate cuts. We do know that we have got to expect a rate cut now in September. And the market acted with some kind of weird flash crash. You may say, well, that's got nothing to do with this time around. Hey, we're just going over the general stats here. And we know that usually the market will drop a little bit after the rate cut itself. Now, it just so happens that we have stats from Wayne Whaley in a moment that will show you that late September into early October, there could be a chance of a little dipping effect, that double dip concept we're talking about. Not maybe to press down to a new low, but certainly to keep this market choppy overall when it comes to returns. Then if we follow the non-recession path over the next 12 months, not over the next couple of years, just 12 months, will usually go well. And if it isn't, will go poorly. And do remember that stay subscribed to the channel because the next 3 months are going to be huge in terms of seeing market structure. The rate at which the Federal Reserve cuts is the most important. I met up with a couple of guys over on X that are pretty smart and know things about the markets. And of course, have done this for a very long time, 20 plus years, 30 plus years, etc. And we all agreed that 50 basis points is the big problem. If it's 25, then it could be going and gearing towards a soft landing. And although I don't personally think it's going to be a soft landing, it will maybe lauded by the market for a while to be a soft landing. Here are the stats that we're talking about. September 23rd to October 2nd. Wayne Whaley's done some great data points here. That seems to be the biggest weakness based on 2 weeks of bad kind of action in the first start of August. And of course, a strong year coming into that event. Earnings results, we saw Tencent do okay. It's rebounded a little bit after selling. And then, of course, Cisco. Then we've got now Alibaba, which is going to be interesting, and JD for the Chinese stock market, and some other big names. But it all come down to, of course, NVDA, which is very soon in the markets as well. Whaley breadth thrust, I keep bringing this data up just so you guys can see it. We had this about, 3-4 weeks ago now. It led us into believing there was a pullback to come after we got this, plus the 70. We got the pullback, ended up being a flash crash. But do remember, the stats are overwhelmingly bullish. 100% of the time after reads such as this, going back 4 decades, have been bullish. It's hard to fight against that. Let's take a look at some strange dark pool activity. We got a big one here on the RSPU, which is utilities. So utilities getting a big trade on them. If you've been watching the channel this year, you'd know I love utilities in late cycle, what I believe is late cycle. Utilities are doing very well this year. And there's been some big trades. Now, they're not me. But I wish I could be that big to get a little bubble put on the screen. But basically, these are still interesting trades. Could it be a take profit? Is it further additional adding? Well, it doesn't look like it's adding because, of course, usually you gain those on the dips. But remember, all of these particular dark pools so far have been on rip points for the market. So interesting. Let's move over to another one, which is the Invesco S&P 500 Top 50 ETF. So it obviously has big holdings in Apple, Microsoft, NVDA, Amazon. Lots of trades, very weird. All dark pool, lots of trades. Are they sells on the rip here? I have no idea, but I thought I'd bring it up just so you guys can see it. Let's move on over to rotation. Of course, we've seen strength in semiconductors, a flat day over the last 24 hours. Gold coming through, healthcare doing well, financials doing well, and utilities now being the worst performer. From being the best performer to the worst performer, that is perfectly normal. We're seeing catch up here. A good smattering of markets over the last 5 days, and this is basically, again, just showing that the markets are relatively happy underneath. There's nothing significantly weak that we need to be discussing there. Let's have a look at the S&P 500. We are now on day 1, 2, 3, 4, 5, 6, 7, and 8. Remember, we thought 9 to 10 in terms of the rally up here. Why do we think that? Because it's happened every other time. Remember, everything's always looked like these weird bear flags, except for once. And that's of the last 5. We had one failure low, and every other one that set up bear flag that we observed last week and posted about has actually just continued to grind higher. We are at resistance, so let's take a look at the futures market. You'll see how it traded. I kind of just want to drive in here. I've got the one-day options expirations there as well if you want to update your charts. But we saw a little bit of weakness here. We went through it actually in our private community. The link's in the description if you want to join that 7-day free trial. And we talked about a little scalp, and it was like watching paint dry, yeah, watching that CPI number. I'm sure a few of you were sitting there going, here we go, and it was just so boring. But we saw basically market go down, market went up, stole the high, came back up, looked kind of weak, got down here. That would have been where I'd break even if I'd held like a little scalp to the low, went a little bit lower, didn't quite get down to something that I thought was a good level, which you can put on your charts, 53.50. That's where I'd expect bigger bulls to come back in if we do drop. And then we drove higher and it just kind of like floundered for the rest of the session, driving higher and higher and higher up towards all of these top lines. Now, the key here is really that we're still in the resistance. Remember, we've got this big red box. We're kind of trapping the market here. I'm very bullish on it. Of course, we have been bullish on the market, but I would still like to see some form of selling around this area just to kind of like trap people into bearish sentiment and then push them forward. It also is better in terms of slowing the market down because you don't really want it ripping off into somewhere. Otherwise, it opens up flash crashes in the future. Some areas to mark out on your charts would be 55.30. That's going to be a huge bull close zone if that does occur. But anything in here, you're looking for structure. And I think based on the last 2 hours of, the 2-hour structure here, we can mark in the low of the last session and say, well, if that's taken, there's a great chance of 53.50, which brings us back down into this area. So I think it could be something like this, which is a very real possibility. That's a guess. At the moment, all of the positions of last week, unless you're kind of taking a little bit of profit on the table, you'd still have to be quite bullish. Let's have a look now at the options market because, yeah, the options market's getting very heavy in calls. Now, we do know there's a lot of expiration this week. 5,600 in general seems to be the most struck overall call level for the big expirations. And we also know, well, that's actually next week's one, but we also know the next 2 sessions, we've got tons of calls around 54.60, 54.50, which is exactly where we are. Now, if the markets start to go bullish in the next session, remember this is showing us positive gamma situation. So it feeds upon itself. The longer it remains higher, the more it can bounce up throughout the day as hedge funds, or in this case, basically market makers, have to hedge off their positions into futures. It creates that positive gamma style event that we're all too used to in 2024. The other thing that I think is interesting is there's a 54.10 massive amount of put sitting there in the next session. So not so much the 15th, but the 16th, we're getting this big put sitting at 54.10. So for now, the markets are grinding higher. There's no signs of weakness yet. We do not have any new lower lows or anything, so you have to remain bullish overall. CTAs, they were caught absolutely, they were caught completely over the last couple of weeks. They got absolutely mauled. I've actually seen some documents saying that CTAs are now down on the year. Yeah, that's what happens when you're in momentum funds. They got driven to a new low because of the VIX 65, forcing them to capitulate. And this is a great reset point for S&P 500 bulls and NASDAQ, because you can see here, they're going to have to get in. So if the market makes those new highs and goes past some of the mentioned levels before, that's going to force them to start adding. And of course, it creates that self-fulfilling prophecy. Silver, a little bit bullish. Copper, certainly showing some CTA signs of life. Gold, a little bit of a rejection after showing signs of life, but still good. Brent is good from the CTAs. And of course, Tesla doing battle on the 200. I would have thought that, well, it's holding above 200, but this is a very important hold. Again, back into positive gamma territory for Tesla. Be interesting to see whether the bulls can get control of this. It technically is in the bulls' favor right now with the breakout of 200 plus, 203 plus. Yeah, we should be seeing bulls, but the last 24 hours gave us a negative 3%. Let's move over to NVIDIA. Very nice. 118. My target was 117 from last week. That is phenomenal. Really very crazy return. 30% is very nice over a week. Don't expect that every day. But we are now faced with the resistance of 120. Again, we are in positive gamma territory. You would not want to fight the semiconductors just yet. We don't have any price action base on that. So we'll update if we do have price action base to go against those particular markets. The VIX has dropped to 16.2, one of the larger drops that we've seen off. I usually never see it go up like this and then completely drop and then not come back later. Do remember, we've done some studies on that. Usually over the next 1 to 2 months, we expect some vol, and we are expecting vol. It's just that right now it's buyback period in the markets, which can cause this kind of bullishness and people having to get in. US 2-year, we'll notice that even with the CPI number, it didn't come down under 3.7, so not much to report there. XLY versus XLP. Now, this is the American consumer, how we track it. Consumer discretionary versus staples. Now, just remember, if it's going sideways for a long period of time, and remember, this has been going sideways now since June of 2023, it's symbolic of late cycle. Now, a lot of people are arguing with me and saying, Tom, it's not late cycle. You know, dude, you're wrong. You're given terrible concepts and terrible, well, they say advice. It's not advice. It's just basically something we're seeing on the charts. Look, it's just my opinion. We're allowed to have our opinions, and I've seen this type of thing before, and it tells me to be a bit defensive. You know, on this channel, I'm still very bullish. I'm still saying that there's things like AI stocks, if you're an investor, yeah, it's in a bubble, no doubt, but they're doing really well. And we like that pull up. We also were negative on semis for a couple of months there coming into this crash. So remember, we trade what we see, we invest in what we see. And what I'm seeing right now is this indicator is telling me there's something wrong with the American consumer. And that's saying we need to be cautious with our overall longs. If you hold utilities or you hold gold or you hold something else and then the market tanks, well, guess what will tank less? The defensive style markets. And right now, you're wanting to track, of course, growth, but you need to be aware of this. And I think it's stupid not to be aware of it. So we just need to be paying attention to that one as always on this channel. If you like that, give it a thumbs up. Because, yeah, I've got quite a few complaints about late cycle discussion. What do you think? Do you think it's good we're discussing it? I personally do, but late cycle doesn't mean crashing tomorrow either. It means usually 1 to 2 years away. We're about about almost 12 months in, 6 to 9 months in from where I've started to see that. Treasuries bounce up. Again, a good late cycle style investment. Pretty boring. It bounced. We talked about bullishness down here. Notice it did it without yields. That's important because what that's showing you is that, yes, people are starting to go a bit more defensive in the markets. Let's move over to copper. Things are looking good here. We like the copper setup. We obviously have been talking about the idea that it could be going bullish. This is a bit of a contrarian call. Most people would be very negative on this chart. I think it's holding. We've talked about this being a possible buy area as well, but it's holding quite nicely. And hoping to see copper up at 4.2 relatively soon. Let's move over to the US dollar. Looks weak. Could be going on the next leg down. We actually marked the legs out. So here's the first leg. Here's the second leg. What happens if we get the third leg? Goes down to 180. So yeah, at the moment, it does look weak. We can see here this rejection wick. So what we'll do is we'll mark that. We close underneath that. Yeah, the market's going bad for the US dollar. Gold, holding, trying to break through. We know this thing's making a series of higher highs or higher lows and equal highs. So we're looking for 2480. Let's see if we can get a breakout. Still looks okay on the chart. Silver versus gold, we know the ratio is down there, which makes it cheap long term. And of course, the silver chart did what we kind of suspected it might. Come down, hit underneath this low, and then start bouncing. Now, this is a very pivotal point for silver. It must break to a new high. If it does, check mark. That's very good. If it doesn't, there are people that are going to start shorting it around this exact zone. So if you're someone that's saying, I hate silver, I'm going to short this beast, yeah, I wouldn't blame you for this exact area. However, I'm still thinking it's looking more bullish than bearish on all of the concepts that we're discussing here. US oil came back to our pullback zone, which is exactly what we suspected it would do. And it's finding some chop around this area. We'll have to update once we get some more information on this because, of course, it's stuck right at that zone. There's nothing to say that oil is bouncing just yet. If you did want to see where it bounced, at the moment, we'd have to see it above 79. That would be very bullish on a swing trade. Tesla holding its own, came back down into this range of 200, kind of area 198. Broke 207, like to see that buy up to 220. Daily 20 moving average, somewhere around there is the current kind of target for that. NVDA, very strong, right on resistance. 118, 120 is resistance. There is a gap fill at 122. This has been a very strong market. And remember, if NVIDIA is beating the SPY, it really shows you that we've got a strong kind of recovery here from the major markets. So this is pretty big. Some people are probably going to draw trend lines through the high here and say, look at that thing, it's on trend line. No doubt it should take a breather here, but we don't know it's going to. Therefore, will crappy stocks such as AMD start to recover? Few people are asking about this. I'm not really sure why. Maybe because it's down 50%. But yeah, it broke through. This was a pretty big daily close. I think that AMD, looks okay. It's very, very low. It's not my kind of replication trade. There is a 2-hour switch in here to the upside. So I guess considering it broke through 138, which is my key, as long as it holds its low, it is theoretically bullish from this point. 700, let's have a look at Tencent. 700 came out with earnings. It was all right. Didn't quite hold super bullish, but I'd like to see this now take that high. Again, I am bullish on Tencent at this time because, of course, I want to see China stocks turn to the upside. Why, you might ask? Well, there's a decent runway if they do actually get some momentum. Inverse shoulders possibilities here now for HSI. Still waiting for 17,450. We'll update once we get that number if we do see it. US 30, one of the better markets over the last 24 hours, showing a little bit of broad base in the markets themselves. But it's the US 2K that I'm most interested in. Close above 2102. Close being the key. I think this is a very good low hold. I think it's a very strong trade level. And this looks like a horrendous bear bust kind of zone. So bears probably looking at this thinking, I'm going to destroy the Russell 2000. I'm not so sure about that. What are you? Are you bullish or bearish this market? I don't think we've got the trigger yet, but if you were bullish down here, I wouldn't be too concerned. Even though this is a horrible looking candle, let's wait and see how this one plays. Yeah, and we'll update as we can go. RSP, of course, improving, which I guess to me means the Russell should be improving as well. And the NASDAQ is floating in the middle of nowhere land. I've put in here close above 19,480 as very bullish, because we're getting above those highs. However, at this stage, anything can happen. We're looking at structure. Check that S&P and the numbers. Now let's go over to Bitcoin. Disappointing Bitcoin, disappointing to come back down here. It's still trapped. You can see it's coiling and coiling and coiling. We're looking for traps either way. I'm still bullish overall on Bitcoin and Ethereum. I'm looking for it to really start ramping though. And at the moment, it just hasn't been able to do that. So we'll keep watching it. In terms of news, we've got core retail sales coming out. So if we go down here, core retail sales at 8:30 a.m., that may move the markets, show whether there's strength, weakness, or anything else in the markets right now. Pay attention to it. Obviously, that could keep it volatile. And as always, we'll be making another video at the close. So make sure to subscribe, follow us over on X, sign up to anything we've got there if you're interested. And if you want to find out some of the replication trades we've done over the last week, some excellent ones from oil to our copper to gold to S&P 500 and NASDAQ and NVIDIA pickups, they're all actually quite replicatable. They're all something that you can just keep doing and doing and doing and doing in markets, in quality stuff. So check out our flash sale as well on our courses if you're interested, particularly the day trading masterclass and advanced masterclass. Both of those have a lot of these concepts in them. Thanks so much, guys. Thank you for watching. Thanks for the thumbs up. We'll see you in the next one.